This video was brought to you in part by SD Bullion.
While some online bullion dealers continue to charge $4 over spot for US Mint Silver Eagles, SD Bullion is selling 2016 Silver Eagles for just $2.29 over spot for any quantity. Again, that's just $2.29 over spot for any quantity. If you haven't joined over 25,000 new customers by making the switch to SD Bullion, what are you waiting for? You could save hundreds or even thousands of dollars on your next order. SD Bullion, the lowest prices, period.
All right, well, I'd first like to discuss about the most recent article you have posted on goldmoney.com. You talk about how you believe that the Fed should increase interest rates. Did you want to discuss a little bit about this?
Yes, I posted an article on this actually. I've covered this subject this week as well, but I first posted the economic reasoning, I think it was last week. The problem is that both bank lending is expanding, and at the same time, LIBOR is increasing quite sharply. Now, everybody's putting the increase in the LIBOR rates down to the change in regulations for money market funds, which is encouraging them to switch from prime lending into acquiring government stock. Now, that would indeed exacerbate any shortage there is in the LIBOR market, but LIBOR's actually been rising for some time. So it's clear to me that the monetary conditions which are going to lead to a price inflation result in perhaps not a huge amount of time, those conditions are now in place. So interest rates actually should rise to stop that happening any further. The problem the Fed has is that the headroom it has for raising interest rates is actually very, very limited. There is obviously a big debate going on within the Fed at the moment, and you have the Dubs who are basically saying we've got secular stagnation. This is a new phrase, if you like, relatively new, resuscitated from a long time in the past. Basically what secular stagnation is an economy that just doesn't respond to monetary stimulation, if you like. So the prospective growth rate for the economy, as far as the Fed is concerned, is likely to be revised down and down and down, despite the fact that they've reached their unemployment targets and also they're pretty close to their inflation target. So you've got the Dubs, if you like, pushing the argument that interest rates should not rise. Normal interest rates actually are somewhat lower because we're in an environment of secular stagnation. On the other hand, you've got the hawks who are taking the view that, if you like, zero interest rates have had very little beneficial effect on the economy. Inflation probably is picking up now. I mean, we can see this in the CPI. Also, there's a certain amount of anecdotal evidence that inflation is actually running a bit faster than the CPI. So one way and another, the hawks are arguing that we should actually try and return to normality in interest rates sooner rather than later. So they would look for a rise in interest rates. I happen to agree that interest rates should rise because I see bank lending rising, and I also see the LIBOR rate rising as well. I mean, LIBOR is already well ahead of the Fed funds rate. LIBOR is currently around about 0.83% for 3 months, or around about 1.5% for 1 year LIBOR. So, if you like, this is the free market telling us that the rates actually should be quite a bit higher than what the Fed has set through the Fed funds rate. So the problem now, of course, is that we have got, we've got the hawks and the Dubs in the Fed. We have got the G20 meeting this weekend in China. Now, at that G20 meeting, I have no doubt at all that the Bank of China and the ECB are going to be pressuring the Fed representatives to not raise interest rates. And they will tell them, you think you've got secular stagnation, we just can't get our economies going, et cetera, et cetera. So you can see that there is going to be a lot of pressure, if you like, applied on the Fed not to raise interest rates. So when those guys return home and they meet, in the September FOMC meeting, you're going to have them on the one hand, you're going to have also the doves, and I think they will probably outnumber the hawks. But there is a problem there, and that is bank lending is beginning to rise, and not only that, but LIBOR is high and sort of seems to be going higher. Okay, there's a technical thing which is going to end in October when the regulations have changed, etc., etc. But nonetheless, there is a problem. Now, I would contend that the politics of the situation are such that here we are in an election year. You don't want to get involved, if you like, in that political problem, but at the same time, you do want to raise interest rates. So I would argue that the best way to achieve that objective, would be to not only raise interest rates, but to announce that the Fed has discretionary QE. In other words, if it deems it necessary, it will go into the market and it will buy US Treasuries off the banks in amounts which are unspecified and not working to, if you like, a fixed amount per month, which is what the ECB and the Bank of Japan are doing. Now, that way, what you end up with is a Fed funds rate, say, running at 0.5 to 0.75%, and that would be roughly 1% above the Bank of Japan's rate and also the ECB's rate. But with the QE in there as well, it would stop the dollar running away and putting pressure back on if you like, the euro and also the yen. So it seems to me that it would be quite a neat solution, and therefore, given that it is a neat solution, it is quite likely that if we do get a rise in interest rates, the pain would be offset somewhat by discretionary QE.
Now, you talked about in a recent article that today's global monetary policies are ultimately a futile attempt to prevent a systemic and economic crisis. And, you're talking about how we're just keeping interest rates super low right now here with the Fed in the United States. Also, one of the mistakes that you say central bankers are making right now is that they think that monetary debasement benefits the economy. Did you want to explain a little bit about this and why that is a fallacy?
Well, it's a fallacy for the very simple reason that if you expand the quantity of money, you're actually transferring wealth from the majority of people to a minority of people. The people who get the benefit basically are the banks, who can create the money, the government, who find that money, one way or the other, is created to buy their debt. And so they have, in effect, fresh money to spend into the economy. The other beneficiaries, of course, are big business, the favored customers of the banks, who get, if you like, the money direct out of the banks, and they get to spend it before it has had any price effect within the economy. But of course, by the time this extra money works through the economy, the poor individual, the low-paid worker, the pensioner, the person who's living on their savings, they find that prices have already risen, but guess what? Their wages haven't gone up. And not only that, but the ability of their savings to earn interest has actually been suppressed. So it's a transfer of wealth from the majority to a small minority. Now, you can understand, if you like, in that context, why the central banks, who after all are very close to the banks and big business and government, seem to be very, very keen on having an expansionary monetary policy. But it really doesn't achieve anything. All it does is it impoverishes everybody. It impoverishes, if you like, the 80 to 90% and benefits just the 10 to 20%. I doubt actually if it's as much as 20%. And so that's really what I mean. This is why an expansionary monetary policy actually achieves absolutely nothing. If it does achieve anything, it's very, very short term, and it is because it has fooled people. Of course, if you fool people, that's not a basis for continuing, because sooner or later they wake up to being fooled.
Now, in the same article, you also discuss about how expanding money and bank credit doesn't actually stimulate businesses. Can you expand on that?
Sorry, money and bank credit doesn't stimulate business. Well, it does. It doesn't. I mean, the only benefit that a borrower gets, if you like, from new bank credit is the fact that they get first bite of a cherry. But all you're doing at the end of the day is you are making it easier for existing businesses not to reallocate capital from malinvestments into more productive investment. And this is one reason why the US economy, I mean, well, not only the US, but all advanced economies, are in such difficulty because there hasn't been the capital reallocation, if you like, for economic progress to take place.
All right. Well, Alasdair MacLeod, I really wanted to thank you for joining us today. Before we let you go, I was wondering if you had any last thoughts you'd like to add and where our viewers can find you online.
Well, I think last thoughts. We've had a very, very quiet period in the markets, really, which is all holiday season and so on and so forth. I suspect that we will get a rise in interest rates, as I said earlier, and I think that could get some volatility going. When it comes to precious metals prices, it's worth bearing in mind that the last rise in interest rates in the United States was in December last, and that marked the turning point for gold and silver. If we get a rise in interest rates soon, I think it will take, it's already discounted, I think, in the precious metals markets. If we get that and we get a little bit of an offset on quantitative easing, if you like, discretionary quantitative easing, then it could well be that now that that is out of the way, that precious metal prices will begin to move ahead again. So I think we've had a very, very quiet, boring period through the summer months, and particularly through August. And I suspect that things might hot up and get a bit more interesting in the next couple of months.
All right. Well, Alasdair MacLeod, once again, thank you so much for your time today.
That's very much my pleasure.
This video was brought to you in part by ReluctantPreppers.com. Click here to watch Reluctant Prepper's latest interview with Brad Harris, founder of FullSpectrumSurvival.com. Where will your family members go in an emergency? Does your family have coordinated and staged plans to get home and evacuate? If severe weather hits while you're at work and your kids are at school, how will you all get home safely? What if there's trouble in your town, your travel route, or neighborhood, and it's not safe to go home? Does your family know how to get to the right meeting place? Brad Harris, emergency newsfeed analyst and founder of FullSpectrumSurvival.com, joins Reluctant Preppers and reveals how to develop a robust, multi-tiered, and field-tested plan to keep you and your family on the same page in a crisis, even when communication is cut off. Start planning your vital get-home and evacuation plans today.